Okay, welcome to the Stableford Capital webinar, and we're going to be talking about some of the highlights of year-end tax planning. So, fun time of the year. Today we have a guest. His name is Mark Barone, and he helped us start Stableford Tax a few years ago. But he's had over 20 years in the industry, last 7 years owning his own practice, and then before that he spent a long time at the Big Four. So, Mark, welcome to Stableford webinar today.
Hey, nice to talk to you, Nate.
So let's jump right in. Why don't you just go over what are some of the highlights as far as some of the changes from the last few years from the tax law?
Yeah, so the tax law, which really took effect, a lot of it in 2018 and some of it in 2019 going forward. Much of the new tax law will go through 2025 and expires in 26 tax year. Some of the things that most people will see. For one, they changed the tax brackets. So they changed it down to 7 tax brackets. And in general, if you're talking apples to apples on your income, you're going to pay less in tax. Most people's income is going to get pushed into a lower bracket rate-wise. The other thing they kind of got rid of is the marriage penalty. In the past, what would happen is when you get married, if I made $200,000 and I was single, I would be taxed at a certain rate. But what would happen is if you were married, you would end up getting taxed at a higher rate. What they've done is they've gotten rid of that marriage penalty up to a little less, right around $400,000 of income. If you get over that, then there's still a marriage penalty, meaning the brackets don't equate going up from single to married filing joint. Another change that was made is they changed the standard deduction. What we had before, we had personal exemptions, and you would either take a standard deduction or you would itemize. And itemizing entails things like, your mortgage, property taxes,
right,
charitable contributions, that kind of stuff. So what they did is they said, forget it. We're not going to have all these extra categories. We're going to take the personal exemptions and we're going to take the standard deduction. We're going to smush it into one category. In 2018 going forward, if you're single, you get $12,000. That's the standard deduction.
Yeah.
If you're married, you get $24,000. And then what happens is if you have itemized deductions over that threshold, depending on how you file, then you itemize. So what it's doing is they're giving people a little more deduction, and what the effect has been, at least for 2018, is less people itemizing. The next thing, which is a big positive for families that have kids, is they took the child tax credit and they've increased it. It used to be $1,000. Now it's $2,000 per kid. But more importantly,
that was nice to see from my end.
For me too.
Yeah.
But the other thing that was really key is the phase out. What happened before is if you made more than $100,000 to $115,000, if you made past that amount, you wouldn't get to take the child tax credit. It phased out to the point where you didn't get anything per kid. The phase outs now don't even start until you get up to over $400,000 of income. So more people are seeing a benefit. And remember, it's always more beneficial to get tax credits versus losing deductions. Deductions don't affect your taxes as much as credits do, right, which kind of brings me to the next point. Yeah, exactly, dollar for dollar. AMT, they changed the threshold for AMT, which is called, it's alternative minimum tax. Basically, what it is, they increased the threshold, so that was a huge thing. A lot less people affected by AMT. The other thing that I thought was kind of cool, a lot of people put money into 529 plans for their kids for school. In the past, that was for college. What they're doing now, as of 2018, is you could use $529 to pay for children's tuition from kindergarten all the way through high school, which is kind of a cool thing for some people that want to go the private school route. As far as things that would be perceived as negative regarding the changes in the tax law in 2018, one of the things they did was, in the past, mortgage interest deduction. They've lowered the limit from $1 million down to $750,000. What that basically says is, if your mortgage is over $750,000, then you have to prorate how much you get to deduct as far as mortgage interest dollars. Some other things that went away: moving expenses. If you're moving for work, in the past that would be deductible on your tax return. It's not now for the individual. So it's important, if you are moving, you're moving for a job, to get your company to pay for it. You don't get the option of the deduction. It doesn't mean moving expenses are not deductible for a company or a business. It just means they're not deductible for us as individuals.
Interesting.
Okay? So that went away. And in 2019, a big one is if you get divorced, Divorce decrees that happen after 2018, alimony payments are not included in income anymore, and they're not deductible for the payor. This is new for divorces that happen in 2019 and beyond. Good for some, bad for others. For most of the clients I deal with, most of the time we're the payor, so that would be probably a negative impact. Another thing that got changed in the tax law is that they're limiting the amount of state income tax you can deduct on your tax return. State and local, and that also falls with real estate taxes. So big states like California, Illinois, New York, New Jersey that have really high tax rates, they're saying you can only deduct up to $10,000 of income and real estate taxes in a year. So they're taking away big deductions, and people in those states are the ones that are most upset about it. Remember, a lot of those people are also in AMT, so some of those people might lose some deductions, but they also probably get knocked out of being an AMT and end up making up tax dollars on the back end. So there's some give and take there. Some other things that happened, which were kind of big, the elimination of a lot of deductions. So in the past, what would happen is if you worked from home or if you had unreimbursed business expenses from your work, you'd go on your Schedule A under other miscellaneous itemized deductions on the bottom of that page, and you'd put that stuff in and you deduct there. You have to get over a 2.5% threshold of your adjusted gross income, and you deduct it. Now, no deduction for unreimbursed business expenses, no deduction for broker fees or CPA fees are not deductible for your individual tax return. But that does not mean that the business you work for, like you go back to your boss and say, hey, in the past I was able to deduct this stuff because I work from home, but now I can't. So can you reimburse me for this stuff? Try to get in front of it and be proactive. The other one is they eliminated the Roth IRA characterization, which was something that a lot of people took advantage of in the past. So as far as positive, negatives, those are some of the highlights. If you have questions, you can always reach out to Nate or myself because year-end planning is a big deal, especially for small business people. If I was going to give you a couple really quick tips as far as things that you can do, I would say maximize your retirement contributions, whether that's a 401k or whether you have a self-employed plan or some type of retirement plan, or that could be IRAs, but maximize that. I would tell you in my practice, it's crazy, and I think I've seen this throughout my whole career. I bet you less than 10% of people maximize their retirement contributions. The next thing would be, if you have the opportunity, a lot of healthcare is terrible right now in our country, right? It's bad. Your choices are bad, especially if you're self-employed. But if you have a high deductible plan, take advantage of health savings accounts. Health savings accounts are great to be able to put money away and have like a rainy day fund for medical. And what happens is if you fund an HSA on your own, you get an above the line deduction. So it's an automatic direct deduction against your income. It's a great benefit. And for 2020, that number, I think, is $7,100 for a family that you can put away, an HSA and get the deduction for it. Most people never get any benefit from medical expenses, right? So as long as the money comes out of the HSA to pay for medical expenses, there's no tax effect ever. You get the benefit. There's no downside risk there. It's a really good thing to do. And I think in the future, you're going to see, I think health savings accounts are going to be a big part of it, because I think having people self-fund as much as they can is huge. So another thing I would say, and it's a simple thing, but for those people that have built up some wealth and want to pass some of that on to their kids or to their grandkids, try to utilize simple stuff like the gift tax exclusion. You can give up to $14,000 a year. Each person can give it to another person. So my mom and dad could give me each $14,000 a year. Take advantage of some of that simple stuff. Because if your estate's under, the thresholds, which are pretty high right now, then that's a simple thing you can do every year, whether you have, a big, huge estate plan or you just have a nice chunk of money that is considered a lot to you that you want to pass on to your kids. And probably one of the other simple tips I would probably give is, state tax credits. We have a bunch of state tax credits in Arizona, and it allows you to give money to charities and kind of direct where you want your state tax dollars to go. In the past, it was great because you not only get the credit, you get a deduction on your Schedule A for a charitable contribution, but because of some of these states that I told you that we talked about earlier, like these bigger states that are getting that are losing those deductions for state taxes, the federal government has put a new law into effect in 2018 that basically says if you contribute to a state tax credit, you get the credit, but you don't get a deduction on your federal tax return anymore because of. There's some states that were abusing state tax credit program. Now, Arizona's been doing this for 20 years, and it's been a real positive program. So we're not one of those states. So I'm hoping at some point they're going to change that in the tax law, and they allow states like Arizona to to get that double dip, which is the deduction and the credit. But either way, you still get a credit, which is, remember, credits are really good. If we remember anything from this, credits and savings and taxes like AMT are good things. So take advantage of that and give some money to some really good charities that need it in the state of Arizona. I think there's 4 major credits. There's a public school credit, a private school credit, there's a working poor credit, and there is a, what is it called? I'm sorry, I'm drawing a blank.
Is it the foster?
Foster care credit. You got it. Look at you, bud.
Yeah.
Thanks for helping me there. I totally always draw a blank on that one. So that was that's the 4th one. 4 big credits. The dollar amounts and how much you can give if you're interested and you've never heard of those before, you can ask us. You can Google it. I'm more than happy to help you on that. So that would be some of the things I would say, just generally easy things that apply to a lot of people that you could do, at the end of 19 and beyond.
Well, Mark, that was a nice little summary. I appreciate that. So I think
sorry, I don't want to get too crazy technical for you.
No, it's really helpful. Thanks again, Mark, for joining us. And anyone that has any questions about anything you heard today, feel free to email. You can actually email inquiries@stablefordcapital.com or call our main number 480-493-2300. And this is Nathan Faldmo, Director of Advisory Services at Stableford Capital. Thanks for joining us today.